Good morning, ladies and gentlemen, and welcome to the EENERGY Group PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it is appropriate to do so. Before we begin, as usual, we would just like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to the executive management team from EENERGY Group PLC. Harvey, good morning, sir.
Good morning and welcome everybody. So we've got a trading update this morning which reflects a very transformational year for the business. As you know, we disposed of our integrated energy management business last year, and as a result of that, we've been focused very much on transforming the energy services business into a scalable and very cash generative business. And I'm pleased to say that we've seen huge revenue growth in the second half of the year. As you can see, we've hit 27 million in the full year, partly reflected by the hugely growing business in the second half. So over 20 million of revenues in the second half, delivering an EBITDA of 2.4 million, which is a 12% margin. So very proud of the transition that we've seen, moving away from an integrated business and seeing that revenue growth coming through, not just from lighting, but also from solar. So as we sit here today, we've got a very strong pipeline as a result of the momentum that we've been generating in the second half of the year. And we have a contracted order book in Q1 into the first half of the year of over 7 million, bearing in mind that this time last year, we did 6 million in the first half. We're now contracted with over 7 million already. So we're expecting a very strong first quarter to follow on from what has been two very strong preceding quarters in Q3 and Q4. Some of the key investments that we've made that John will talk through later in the presentation are around building new systems and platforms for a standalone energy services business. Obviously, as we were an integrated business, there was quite a lot of disruption, quite a lot of systems and architecture that had to be unwound that went with the energy management business. And we had to reinvest quite heavily into both technology platforms, but also systems and processes so that we were set up for a scalable business model going forward for energy services across both lighting, solar and EV. We reduced our cost base in the second half of last year, which John will talk through. And we've got a much more focus around cash generation now. So I'm really pleased with the progress we've made. We've seen a record pipeline being developed. And as you know, we have a 6-month sales cycle. So we're starting Q1 with an extremely strong pipeline as a result of the work we put in from June onwards. I think we've seen some really pivotal frameworks being initiated in the business, and we'll talk about that shortly. But notable wins are the NHS Commercial Solutions Sustainable Framework and a nearly £1 million award for a university college group. Macro tailwinds with us now, with the new government investing very heavily into the public sector, which is driving quite a lot of additional channel revenue into EENERGY. So yeah, very pleased with the momentum in the business. It's all organic growth, and we're starting to see that investment we've made in the pipeline start to bring real profitability to the business. From a market perspective, as you know, we were very much an education business in energy services. And whilst that's an exciting sector, still a £2 billion market, where 65% of the schools that are in the UK market across all the various subsectors of education remain untapped. We've pivoted and started to think about further education as a really key addressable market. So universities and colleges are now a very big part of our strategy, and we're starting to see £1 million plus accounts starting to be developed within our pipeline that are having quite a big meaningful impact on our P&L, because previous deal values were around the £150,000 mark, where we're starting to see £1 million accounts being won in the further education sector. It has a real big gearing effect on our P&L. So education is still a very big market for us, but further education is enhancing that and giving us a longer tail of opportunity. We did quite a lot of market research last year independently to assess the addressable market. And so these figures are the result of looking at those markets very deeply. And 65% addressable market gives us a good 5 to 10 years worth of available work in LED, and 10 years and beyond in solar. So a lot of investors have mentioned over the years, have we got a limited time frame for the education market based on essentially a niche market and us being so successful? We are successful in this space, but we've got less than 2 or 3% market penetration at the moment. We want to get 10% market penetration, and we believe now we've got a long enough tail to do that. The other key market opportunity for us is in the NHS, where we've seen a 50% addressable market available within lighting. And we think this is a £5 billion market across the net zero initiatives that we operate in. So frameworks are a key part of this for us. We see this as being a big part of 2025. And we've got some exciting projects in the pipeline that we're developing. And I think we're going to start seeing those come to fruition in Q2 and Q3. I mentioned the government. The government's new initiatives in public sector are helping us enormously. There's a real rush to demonstrate, I think, to the UK public that we are in an environment where the government is taking net zero seriously. We're starting to see much more investment coming through for frameworks in this education and NHS space. So that's helping us. And we also think that the 10-year tenure that we've now got within energy services is giving us a real competitive advantage and creating a high barrier to entry. So we've seen a lot of small players disappear from the market, a slight consolidation around the key players. And as we start to go up the deal value chain and north of the £1 million mark, obviously there is a much more credentials-led tender process, and EENERGY is now capable of tendering against some of the big infrastructure players that are in the market. Without question, our differentiated funding model is creating a point of differentiation generally in the market for us. Budgets are tight. Public sector budgets have been limited outside of some of the government grants. We still see huge pressure in education, NHS and universities as a result of everything from national insurance increases and all of the various pressures that these businesses like universities are facing at the moment. And the ESG agenda remains very, very priority. So for us, being able to offer a zero capital solution is becoming more and more important for these customers. Solar is surging in demand, which is as expected. We're starting to see the size of our solar projects increase in size and scope, which is also driving a huge amount of momentum within our business. When we look at the drivers for FY25, we've picked out a selection here. Obviously, there are a lot more than this, but these are the main ones that we're most focused in on. We talked about government backing the investment environment around grants for certain LED projects in schools. That's helping us, and that's sort of a previously unbudgeted revenue channel for us. Capital-free solutions, without question, is driving a huge amount of conversion in our pipeline. The ability to assess data in the process sets us apart from our competitors. We have a very data-driven surveying and assessment process as part of our sales cycle, and that's really, really key as part of providing a fast-track process from an opportunity opening up and closing that opportunity, and then providing optimization of that data once we've delivered the project. Customers now insist on a turnkey solution. They don't want to have to manage the project. They don't want to have to manage procurement. So a turnkey solution for us is, again, a very big differentiator. The adoption of solar, it's trading at 50% discount to grid energy. So anyone with daytime consumption and with roof space or available space for ground mount, it's not a question of are they going to be doing solar. It's a case of when. Our job is to convince our customers that time is the biggest value driver in any project. So that's a real driver for us this year. And then the expansion into universities and NHS trusts, again, as I mentioned, a massive value driver. The £1 million projects that we're now seeing come through, and some multi-million pound projects, have a strong inflection point on our P&L given the gearing effect. Routes to market. We've been talking a lot about bids and frameworks. That's not to dilute the impact of our direct sales strategy. We've doubled the size of our sales team. We've adopted a regional approach to bring a more focused, account management strategy around the way we manage education in universities and healthcare. This is proving to be extremely successful and efficient, and we're starting to see that come into its own momentum now. Bids and frameworks, we're on 5 public sector frameworks now. That's up from 1 this time last year. We're expecting to be on 1 or 2 more in the next quarter, as we've been planning. Those are critical for our success on multi-site £1 million plus projects. And then in solar, what we're doing is we're launching and leveraging a partner network where we're working with partners who have influence over multi-site commercial industrial, whether that's landlords, whether that's industrial developers and or portfolio managers of large estates. So the 3 key target areas for us, very focused: education, healthcare, and CNI for solar, are the routes to market for FY25. I see this business as being in 2 parts. We're in part a developer and a development platform, and we're an EPC solutions business. The pipeline is essentially the heartbeat of our business. As you can see, we've increased our pipeline from 258 million to 375 million over the last 6 months. That demonstrates that huge momentum that we've seen within the period June to December. So a 45% year-on-year increase. 26% of that pipeline is an investment grade proposal. That means that we've gone through the investment of assessing and delivering to key decision makers within our, if you like, key stakeholders of our prospects. That is a significant improvement on this time last year. Again, nearly 100% above where we were for lighting, and more than that for solar. We have a historic 55% conversion rate of investment grade proposals. Now, whilst our budget is not to convert 50% of that 98 million this year, that partly results in a longer tail of, sales cycle, particularly for solar. But what it's giving you is an indication of the long tail of value that we're building, not just in 2025, but also in 2026. So that's for multi-site customers where we've done perhaps lighting, and then we'll do solar 6 to 9 months afterwards, or where we're going through a detailed and comprehensive appraisal of the solar development cycle. 33% of our customer contracts last year were from existing customers. That's testament to delivering good quality service and effectively the opportunity with our customers that is changing in their profile that gives us a longer tail of revenue. So as we think about Q1, we've got a pipeline of weighted forecast that's delivering confidence in our first half, 7 million of which is contracted. This time last year, we were expecting to deliver 3 million first quarter. We're looking to double that this year, and I think we'll do better than that in the second quarter. So you can start to see the momentum we're getting with our pipeline, but also the predictability and the ability to more accurately forecast as well, which is helping us manage the business better. So I'll hand over to John to talk about the accounting and the work he's been doing, and I'll pick up to talk about some of the outlook.
Good morning, everybody. So I just want to talk about the accounting adjustments first before we talk about FY24. So obviously with the new CFO in place, I joined in October 2024. It's right that I did a detailed balance sheet review, and effectively the accounting adjustments are designed to shift the revenue and cost into the right period. So we ended in December 2023 with a significant accrued revenue balance of about £7.6 million. And having looked at that balance in detail and looked at the gross margin on the business that we've done in the first half, it was clear to me that the revenue recognition policy needed a little bit of tightening up, which is effectively what we've done in 2024. And then we've gone back and restated 2023. So effectively, there's 2.8 million of revenue and a circa 1.4 million of gross profit, which comes out of 23 into 2024. And that's where the revenue and those costs should sit. We've also taken opportunity to review the balance sheet in detail. And there's a further £2 million non-cash adjustment. These are all non-cash adjustments. It's a further 2 million reclassification to remove the historic project accounting balances from the December 2023 balance sheet. So in total, that's 4.8 million of revenue adjustment into 2023. And the gross profit is reduced by 3.4 million. And for 2024, effectively, as I said, 2.8 million of the revenue from 23 moves into 2024, which is where it should sit. And 1.4 million of the gross profit moves from 23 into 2024 as well. We've also taken the opportunity to write off legacy debtors related to the energy management business. As we know, the energy management business was sold in February 2024. Some of the legacy debtors that were sat within that business are unrecoverable. And I think it's appropriate that we make an adjustment back in 2023 and write those debtors off as an exceptional charge, effectively below the EBITDA line. Overall, I've introduced a much more disciplined approach around revenue recognition and project accounting. And I'll talk about that in a little bit more in a second. And of course, all the accounting adjustments are subject to audit. So let's move on to the 2024 results. Results were in line with market expectations, both within the 10% threshold. So revenue increased by 14.4 million to 27.1 million, and adjusted EBITDA increased by 4 million to 0.4 million. So both in line with market. H2 2024 was particularly strong. This is all organic growth. There is no M&A in these numbers. It's all organic growth. Revenue was up over 100% to 21.1 million in the second half, with an adjusted EBITDA in H2 of 2.4 million, giving us an EBITDA margin of circa 12%. That's moving in the right direction towards our target of sort of 15 to 20% EBITDA margin, which we think is achievable. So in total, there were 4.2 million of exceptional charges in FY 2024. The cash cost of those exceptionals is circa 3.6. And actually, if we look back over the course of 2024, extracting ourselves from the energy management business, which was highly integrated with energy services, took significantly longer and cost more than we initially expected. We also had significant deal costs around the disposal of the business and also the subsequent restructuring, where we've invested money into developing our own technology. And obviously, in the second half of the year, we made the decision to close Ireland, which resulted in some exceptional costs coming through. So I guess the key message for investors for 2025 is we're not expecting exceptional charges in 2025. That's the key message. So we closed the end of the year with 2.3 million of net cash. Prior year comparative was 7.3 million of net debt. And effectively, post June of 2024 this year, we've invested 1.1 million in NatWest funded deals. That money will then turn into additional cash for us over the next 7 to 10 years of circa 1.7 million. We've also invested around 0.4 million in EENERGY platforms and system improvements around Salesforce, NetSuite, and some of an in-house app which we've developed around helping our LED business. And we've also, towards the latter part of H2, made some significant fixed cost reductions, such that we expect to be cash positive in the first half of 2025, which is typically the weaker half of our two trading periods. So one of the things that I focused on since joining EENERGY is to really take a really close look at the operations and controls in the business, and to try and get the finance team working much more closely with the LED and the solar businesses. And effectively, we've made significant investment in NetSuite to help enhance our accounting information around gross margin, around net cash, around net working capital, all by project, and to try and join up finance with the operational teams to make sure that we're maximizing all of the opportunities across the business. So there's a big focus now, much more focused, I would say, on cash flow and gross margin, which we're looking at sort of week to week in regular meetings and dialogues, using the accounting information to try and drive and make meaningful decisions, data-driven decisions, which will enhance the operational performance of the business. We're also looking at all the vendor contractual terms. Obviously, as our business scales, we We need support from vendors around being able to meet our needs as we go forward. And we're looking at credit terms and also pricing very carefully to make sure we're getting the best value for money and maximising any cost efficiencies there for us. I think our overall objective for me and my team this year is very much focused on improving our profitability and cash flow. That's absolutely where we need to be focused, and we've already made great inroads with that already. And I look forward to reporting on that at the half year. Thank you.
Thank you, John. So when we think about the outlook, we've got huge confidence in our pipeline. We've got a record contracted forward order book in Q1, and that demonstrates the work we've done in H2, but also underpins the strong market demand. Positive EBITDA for H1, and although the first half is usually slower than the second half, we think we can start to smooth out those 2 periods, in particular driven by the sort of less seasonal impact of solar. Strategic focus on the broader higher education and healthcare markets, partly driven by frameworks. This is going to drive significant value opportunities for us. The efficiencies that John's talked about around our operating model, very much gross margin focused, cash generative focus on all projects, thinking about the way in which we work with our various supply chain partners so that we can scale the business without effectively sucking up net working capital. It's a real big part of the strategy going forward, which we are confident we can do. I think the profitability of the business, the EBITDA margin enhancement, is something we've got our key objectives focused in around. The senior leadership team are very much focused on how can we drive EBITDA efficiencies in the business. And we've got a debt-free balance sheet, so we've got a strong financial business, and we've got a strong pipeline to drive profitability in FY25. So in summary, record H2. I think the EBITDA that's coming out of Q3 and Q4 shows what's possible in this business. We see that maintaining momentum. The market generally is finally getting its act together with regard to a net zero focus as we race towards 2030. The new government's helping that. And I think also aging infrastructure is also helping in a big way. This start to be a significant focus. With a leader in our sector, so for education, without doubt, we are known as the leading brand. That's starting to infiltrate into colleges and universities. To put that into context, we've got one university we're working with that has over 200 buildings. The total opportunity for that is a 3-year opportunity in excess of 8 figures. So if we can really drive momentum in the further education market within universities, I think there's an opportunity for us to really drive profitability in a big way with these large projects. Strong start to 25, quicker out of the mark this year. Usually the first week of January is very slow. This year we felt a lot of momentum very quickly. The off-balance sheet funding, again, is a massive advantage to our business. We're starting to think about new partners. We're starting to think about how we can expand on our NatWest facility with other strategic funding partners that can help us, in particular with the commercial. As you know, NatWest is a public sector facility. We're working with our new partners around C&I funding for larger multi-site projects that are not in the public sector. And our investment in the operating platform is starting to bring efficiency. So what that means is we can scale the business without increasing materially our headcount costs. So I think what Q3 and Q4 showed was that we have got a run rate business of 40 million, given that we did over 20 million in H2. That run rate business was able to deliver over 2.4 million of EBITDA in that period. That does suggest that that cost base is quite capable of delivering a 40 million pound outturn without any further increase in costs, and that we've got a 5 million plus EBITDA business run rate. So the potential there for scale is huge, and the potential for gearing in our P&L is really quite exciting. And that concludes our presentation today. So, happy to open up to questions, and thanks for your time.
Perfect. Harvey, John, if I may just jump back in there, and thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can all be accessed via your investor dashboard. Harvey, John, as you can see there, we have received a number of questions from investors, and thank you to all of those on the call for taking the time to submit their questions. But Katie, at this point, if I may just hand over to you to chair the Q&A with the team, and if I pick up from you at the end, that'd be great. Thank you.
Thank you very much, Jake. To start with, we've had several questions around the contingency payments for the sale of the energy management business. Are you able to give any indication on both the initial and second potential instalments, or due to it not being mentioned in the trading update, is your view that nothing will be received?
So let me answer that one. We don't know at this stage how much the deferred consideration will be. We had initially envisaged it would be circa 8 to 10 million. However, we have assumed it will be circa 5.5 million is our current thinking, but we won't know the final answer until January 2026, when the final measurement period has been completed.
Thank you, John. We've had a few questions around the frameworks. The first one is how much revenue is expected from the frameworks?
Okay, so it's hard to predict. In our budget for this year, we've only budgeted for a couple of million to come from frameworks. I think we can already see that being deliverable from the pipeline we've got. The upside potential is huge. Many of our frameworks are closed, and therefore we see bids and tenders coming through them to a select number of framework participants. So we expect those frameworks to get busy in the year. They come to the table with projects that are ready to go. So so long as we are seeing the ability to bid for those frameworks within the first 6 to 9 months of this year, we've got the potential to deliver and recognise that revenue. So potentially a huge number, but budgeted 2 million for this year.
Thank you. Someone's asked, why are you being so successful with the frameworks? And in terms of the frameworks, typically, how long between the bid and acceptance of the bids? When do you expect to start to get some bids accepted? And will you inform the market of each successful bid?
So clearly, material project wins get captured either in a reach or an RNS. So yes, I think the cycle for solar deals is quite different to the cycle of LED deals. So with an LED deal, multi-site, £1 million plus project, we can be at assessment phase and fully recognising all revenue within 60 to 90 days. So we could quite easily see, 90-day turnaround of revenue outside of our budget, even in October. So we've got 9-10 months worth of opportunity coming through the business. With solar, the sales cycle and the development cycle are longer. So we would need to see opportunities coming through to us by June in order to be able to feel confident we could recognise that revenue through the into the December year end. I think the success formula for frameworks, getting on them and winning them, is again different according to the sector. So in education, it's credibility, it is supply chain pricing. So I think one of the reasons we're being extremely successful is because we've got 10 years of experience, over 750,000 luminaires installed across 1,200 sites, gives us quite a head start on our competitors. I think our price point in our supply chain means we're extremely competitive. And we've invested quite heavily in the accreditations and compliance around the various scoring mechanisms that make winning a framework successful.
Thank you, Harvey. Next, a couple of questions around the funding, and first on NatWest. What sort of IRR do you expect on the 1.1 of NatWest funded deals, and what rate do you pay for the funding?
So I'm not going to disclose the rate we pay because it's sensitive in the market. What I can say is that we retain 20% of our revenue into our projects. So we are leaving behind a retained interest in the project alongside NatWest. So instead of cashing out our margin in cash on day one, we leave behind 20% of our revenue. And that revenue then obviously accrues value over the course of the term of the contract. So as John indicated, 1.1 investment will end up yielding a 1.7 to 1.8 million return to investors over the term of the contract, which we collect quarterly. So it's a small but nonetheless important recurring revenue stream that we're building. And so hopefully that answers the question.
Thank you, Harvey. The other one was about providing a bit more detail on the funding available to clients. So obviously aware of the NatWest facility, but they noted in a previous presentation about Sisemans as another source of finance, and if you could expand on that at all.
Yeah, so as we've stated, NatWest is a public sector facility. It's designed to be very much focused around our 3 technologies in healthcare, public sector, and also local government as well as NHS. So outside of that, obviously we have independent schools, we have universities, and we also have all of the C&I projects for solar. So what we have is a panel currently of 2 or 3 retained funders that have underwritten our contract form over the last 7 years. So Siemens is one of them. There are others which I won't mention because of the competitive nature of what we do. However, we are in talks with a strategic partner that we think could bring a lot more than just funding to our business. And we hope that we will be able to pull together a broader project funding offer that covers more than just public sector as we start to really scale our solar business.
Thanks, Harvey. On the note of strategic partners, there's been a question around what the thinking behind appointing John Hornby, the CEO of Luceco, to the board, and just about Luceco's competitiveness with EENERGY.
Yeah, look, it's a good question, and it's an easy one to answer. Luceco are a incredibly well-respected and large supply chain partner in the technology space and energy services, in particular around LED, but also around other component parts, but also EV. That relationship is getting stronger by the quarter. We're getting improvement in our pricing points regularly. It is a strategic partnership where we are obviously both mutually bound by our confidentiality around pipeline. So we don't ever have a worry that our pipeline of projects could be in any way circumvented by Luceco. That's just simply not in the spirit or contractual nature of our deal. John's a fantastic non-exec. He's been with us now for nearly a year and has been a huge contributor in board meetings. And he runs a public company himself. He provides good governance. And whilst there is obviously, an interest in progressing mutual sides of our partnership, he also brings a sense of independence as well. So I think it's a great partnership, one that I'm investing in and one that's yielding strong results.
Thank you, Harvey. Looking towards the cash aspect, can you provide more detail around the cash balance and where the funds from the EM sale have been deployed? And is the business now cash generative?
So let me answer that one. So at the time of sale, the energy management business back in February, all of the group's external debt was repaid, all of it. And in the second half of this year, cash has gone backwards slightly as we've invested, as I said, in some of the systems, and we've continued with some of the exceptional items, which obviously we won't be carrying on in 2025. Cash at the end of the year stood at 2.3 million. There is no debt in the business as we sit here today. That's excluding sort of a relatively small sort of right of use asset, IFRS 16 liability. So yeah, positive net cash, and we're expecting to be cash positive in the first half of 2025. Yes.
Thank you. Just about the exceptional items as well that you mentioned, and if there's any further details that can be provided around them.
So we'll provide a more detailed breakdown in the annual report of exactly what we spent on each of the items. But obviously there was a significant amount of restructuring over the course of the year to extract the energy management business from the energy services business. I think it's fair to say that the businesses were much more sort of closely aligned in some of the legal entities, and therefore extracting the assets and liabilities in relation to the business that's been sold, and also dealing with all the sort of legacy issues around trying to rebuild Salesforce data, rebuild NetSuite data, et cetera, et cetera. There were some considerable costs associated with the sale of that business. So more detail to be provided in the annual report.
Thank you. For the accounting adjustments to debtors relating to the sold energy management division, do those debtor balances belong to EENERGY and not the purchaser? Irrespective, does the performance of those debtors impact the calculations and economics of the deferred consideration to be received?
No, it doesn't impact the calculation of the deferred consideration. I think one of the problems that the business had is that a lot of the customers were common to both businesses, energy services and energy management. Historically, we'd not strictly split out exactly which debtors related to which business, but that was part of the work which was done in extracting the energy management business from the rest of the group. So there isn't an impact on the deferred consideration, and effectively those debtors weren't sold as part of the sale of energy management. And effectively, there's a non-cash write-off to clean up the balance sheet at the end of December 23 for that disposal.
Thank you, John. Looking to cost cutting, someone's wondering if you have any exact figures. Where have you cut costs, apologies, and by how much?
So we've probably taken around £500,000 of cost out of the run rate of the business, primarily in a couple of areas where we've harmonised roles and shared the workload across other existing members of the management team. It puts us in a position to make sure that we can be cash generative in the first half of 2025, which is obviously critical for our business given the financial performance over the last 12 months.
One of the other areas that I think is important to know, our investment in systems and tech has enabled us to be more efficient at the assessment stage in our development cycle. So we were incurring nearly £250,000 a year in assessment of LED projects. The app, which is now 80% in its development cycle, has already seen a 35 to 40% efficiency gain in the way in which we are able to automate the assessment of lighting projects. That's enabled us to remove the external parties that we're working with and also some of the fixed costs we had in that department. So that's been a real efficiency gain. We're doing the same thing with solar. And I think as our thoughts around technology in our development cycle improve in terms of how we optimize, we're going to start to see the business scale, but with a smaller cost base.
Thank you both. A question on account receivables and ability to pay people. They note account receivables have increased by 5 million in H1, and noting that they thought this was already relatively high. What are you doing to bring this down?
Okay, so first of all, let me just state we don't have an issue collecting debtors. Occasionally, debtors may take 1 or 2 extra weeks to pay us, but that is not the norm. You'll see in the annual report that we'll set out in more granularity exactly what the trade debtors are. So we're not putting into the same category trade debtors, accrued revenue, other debtors. We'll carefully split out and analyse with commentary exactly what those debtors are. So I just can reassure investors that the debtors are tightly controlled, tightly managed, and we don't have a debt collectability issue. So that number that's being quoted in the notes there in the questions is actually higher than the actual real trade debtors. There are other totals in there which we need to separately analyse to allow investors to understand really what the net working capital position is on the debtor side of our business, and we'll certainly do that in the annual report.
Thank you, John. A slightly different one. Someone's asked about Trump tariffs. Trades were obviously terrible for business, is what the comment says. Do you see any impact on EENERGY going forward?
Crikey, that's a big macro question. What I would say is that, look, we don't have an American market. That said, we have got a couple of interesting projects that have come to us that we may decide to fulfill in America that came out of one of our events we did last year. We don't have a supply chain from America, and I think maybe the question is there a macroeconomic influence happening that's going to drive an impact to our business? I don't think so. Public sector is driven by government policy on our side and driven by subsidies and driven by compliance and ESG targets that are being set. So if anything, I think it harnesses the UK's approach to ESG it makes us look like a potential beacon of hope around what we can do with ESG. And I think that the public sector is very focused around showing the public that they can get to net zero by 2030. And that's really got nothing to do with the Trump trade wars.
Thank you, Harvey. Looking at EBITDA margin, someone's questioned of the 12% and questioning whether it should be expected to be nearer 20%. Are there any comments on that?
Yes, I have to answer that one. It was 12% in the second half of 2024, but obviously we've taken some cost out of the business. We're much more margin focused now. We can see that the projects which we're winning work on for LED and solar are better margins than we've historically enjoyed. And I think 20% is a realistic, 15 to 20% is a sort of realistic EBITDA margin on a sort of adjusted EBITDA over revenue as a ratio. So I'd expect significant improvement in that ratio over the course of 2025.
I'd like to jump in here as well. I think, look, it's a very good question. And if we stripped out the LED business without incurring the cost of developing organically an equally sized solar business from scratch, and bear in mind that from scratch we've built a 13-14 million turnover solar business within 2 years. It's partly where a lot of our investment's gone. So when we think about where's the cash gone, it's also gone into hiring a solar team from scratch that we would otherwise not have needed if we were just an LED business. If we were a 15 million LED business and we were a private company, we would probably be on 25 to 30% EBITDA, right? And we can see that as John and I go through our divisional analysis, we can see that we've got an incredibly exciting LED business that is growing and building scale again, and the solar business is just catching up. So I think we've got a little bit of a drag on our exciting rich margins coming out of LED, but we've got a much bigger market in solar, which has got potential for a lot bigger scale. So I think 20% is a target that we aspire to have. I think it is the right number eventually. And also bearing in mind that the investment in our fixed cost base gears quite quickly once we get tipping points in revenue. So for every million of revenue you go past, let's say, a 30 million, you get a much richer drop through to the bottom line. And so our real goal is, can we scale this business to 35, 40 million quite quickly? And can we start to see 20% plus margins coming through? Yes, we can. We just need to start winning bigger multi-million pound deals with the same team that is more than capable of doing that.
Thank you both. Just a few more questions. Why is the first half of the full year traditionally much less profitable than the second half?
It comes historically from the lighting sector. The lighting sector, as an overall trend, has a very strong second half. I know it sounds strange, but it's partly as a result of the light in the evenings getting darker past September has traditionally been a strong Q3, strong Q4 for lighting. The education sector amplifies that in the sense that the capital refurbishment cycle mindset of education was always to deliver all its projects in July and August, which do sit in H2. So there's a natural LED shift, if you look across the sector, to a stronger H2 and an education bias towards allocation of resource within our client mindsets to have second half installations. We do expect it to smooth out a little bit more this year. Last year was particularly worse because we were impacted internally at a micro level as a result of the restructure and as part of the disposal that sort of blew up our operations. In pipeline development in the first and second half of H1, and so for 2023, our development pipeline was imploded because of the distraction on doing the sale process, and then the integration of the sale process and disposal then caused us a headache in the first half of the year. So we had sort of two hits.
Thank you, Harvey. Second to last question, how do you physically deliver the projects? Through subcontractors? Can you take them through that a little bit more, and how do you control that effectively?
Okay, so within the lighting operating model, we have a full end-to-end turnkey operating model where the only piece of the project that we don't physically, through our own fixed cost base, manage is the electrical install of the lights on site. We project manage them on site. we manage all of the supply chain elements, everything from health and safety to the project management to the access equipment to the disposal of product. We do all of that, but we don't physically do the electrical install ourselves, although we have on-site project managers supervising on the whole journey of a customer's experience. We're moving to a almost replica model with solar. So we don't have the balance sheet risk of labour on our business model, which is a hybrid and I think attractive model, investment-like model for our investors. But we have a very close hand-holding project management service that we deliver to our customers.
Thank you, Harvey. And just the final question, is there an opportunity for operational and maintenance contracts after and for solar projects? And if so, the annual sales value?
So there is. We've kept it off our, I guess, budget for now because it's a small but growing part of our strategy. We have an emerging offer to our customers where we do the full O&M over the life cycle of our developed projects, whether that's being funded or not. And we believe that this is going to be quite a profitable business model for us. So as the year unfolds and we've got proof of concept, we think this is an attractively high margin business offer for the business, for shareholders, but also extremely added value benefit to our customers as well and to our funding partners. So we will be doing more updates around O&M for solar, not for lighting, because we don't have an O&M requirement for our lighting businesses. It's all covered as part of our contract. But for solar, it is quite an exciting part of our strategy.
Katie, Harvey, John, if I may just jump back in there, thank you very much indeed for being so generous of your time and addressing all of those questions that came in from investors this morning. But Harvey, perhaps before really just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Sure. So we recognise that it's been quite a long trading update this morning with quite a lot of moving parts around last year. Hopefully today's presentation clarifies a lot of the questions. We think we're in an amazing space now. We've got a market-leading position where there are a number of tailwinds, and with the brand credibility that we have, we think we are in a market-leading position to scale this business now and really achieve some huge profitability over the next 12, 24, 36 months.
Perfect, Harvey, that's great. And thank you once again for updating investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of EENERGY Group PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good morning to you all.